All right, welcome back, yield nerds. This is the second part of value investing, where we look at currency and its impact on value investing. My usual disclaimers: you make the decisions. My job is to educate. There is no sponsor. I'm not endorsing products or politics. Couple of things before we dive deeper. This is part two. There is a playlist. I've put a link to the playlist right there. It organizes the entire show in sequential order. Feel free to refer to that. We're going to look at a couple of things today. We will very briefly, as in within a minute, recap what we talked about value investing 101 in 20 odd minutes. We're going to focus on sovereign debt, which is really the foundation of an economy, and also use that in value investing in the next episode when we look at enterprise value and debt for a company. We'll look at two case studies. One is the country of Pakistan, which has an economy that is stronger than Finland. So let's not think of it as a country that, it is number 40 in the world order in GDP. And we'll look at what is happening. And then there is a fictitious country called Saint Neldangi. I just made that up. And we'll look at that and kind of transpose what is happening. Why does one succeed? Why does the other have certain structural problems and so on? And then come back full force to July 2023. What does it mean for us and where do we go? All right. In the previous episode on value investing, we picked certain commodities and goods and saw what happened to purchasing price, the indicators for buying the same basket of goods, CPI and PPI. And we found that there is something very interesting that happens in rock salt. If you did not watch the previous episode, here is a link to that. And it shows what happens to PPI of rock salt during recessions. We created a framework for what wins in a recession. We then said, hey, the wild card is currency and debt. And that is what we're going to dive deeper in this episode. Okay, I want to step back and say, what does it mean for a country to default? What does that term mean? To do that, we're going to look at sovereign debt or sovereign surplus as a concept. There are countries that simply make more than they consume. And examples of those are Germany, Japan, China. These countries have a sovereign surplus. They can use that surplus to pay off past debts. They can use that surplus to invest in their companies. And so these are companies with free cash flow, effectively. And these are countries with free cash flow. In the other end of the table, unfortunately, at the top of the leaderboard is the United States. It has a very high sovereign debt. Now, the US GDP is phenomenal, and so a high sovereign debt within reason can be balanced if you have a really high GDP. The United Kingdom cannot say that. Certainly, Kenya cannot. And so these are countries that have a very high debt load compared to their GDP, and you will see where that goes. As a percentage of the GDP, and that is the measure where you have to step back and say, is it sustainable? So this is the quote debt to equity ratio, if you will, for a country. Japan has 2.5 times debt as it produces. In other words, Japan would have to take everything it produces for the next 2.5 years to service its debt. That is astounding if you think about it. Italy, Barbados, and some of these are small countries, but even then, it's precisely the fact that their GDP is small, which makes a debt to GDP load like this a very tough pill to swallow. To finance this deficit, you have to go somewhere, and that is where the countries issue debt. And the US issues treasuries. And then the main indicator you have to look at is, hey, if I'm telling you, sure, you can buy my debt, where is my GDP going? And the shape of this little curve here is astounding. The US has been on a trajectory of continuous and slower increasing GDP. Look at China. There is a literal hockey stick. And that is why China emerged as the second biggest economy. India was somewhere way below, 40th in the world, And India is having that same kind of hockey stick, while Germany, some of the other countries, Japan, you can see is plateauing, and that's not good news. But at the end of the day, the US economy is so large that investors are willing to lend to it despite the deficits. It's again kind of like the too big to fail type scenario in a company. So what is that debt? That debt is treasuries. When you and I buy treasuries, we are saying, I know the US has a deficit. We're going to buy the debt so the country can invest in the things its politicians think are the right things to invest, hopefully to create a surplus to then pay off the debt. We cannot print money without approval from Congress. And given the current account deficit, you need to print money because we are spending more than we are making. And if you have to print money and you need approval from Congress to print money, checkmate in July 23. Without approval, we will not be able to service debt. That's kind of what's happening in a nutshell. To be clear, both parties agree debt is not good. The disagreement is really what is the plan to tame it? When do we do certain things? When do we not do certain things? What do we sacrifice? So that's kind of a philosophic debate, which may or may not take very, very extreme steps towards the middle of the year. And our goal as yield investors is to say, what does history teach us about defaults? What happens that you can sit back and say, how can I be a smart investor? And even when there is a threat of a default, what happens? If we understood both of those, we'll make smart decisions. So I'm going to go with this crazy story. It's this country I'm going to call Saint Neldangi. And Saint Neldangi is a wonderful country. It has really good weather and it produces precious metals and machinery. That's what it exports. And it provides professional services. Very nice. It imports gasoline and cars. So, with gas price increase, you can imagine St. Neldangi has some structural problems lately. And they do have a current account deficit, which is a pretty high percentage of their GDP. And overall, I mean, this looks like any other country, I suppose. A couple of things happened in the last few years for St. Neldangi. They may have had some global problems. They did some things that maybe their neighboring countries aren't too enthusiastic about them. Well, the US did things like that as well. They have some supply chain issues. Well, we have that too. And some bad weather came and disrupted domestic production of certain things. I mean, we've had bad weather too. The reason I keep comparing them to the United States is the problems that this country, say Neldangi, had are somewhat similar, um, except this country is very dependent on import markets for specific goods. And the import markets also experienced drought. And the import market said, well, we don't have enough to feed our people. Maybe we don't have enough tomatoes. And if you import tomatoes, I'm going to charge you 3 times the price. And then you have to put it on a ship and pay for gasoline, which also costs more because you're an importer. And so the bottom of the supply chain started shaking, increasing costs, and St. Neldangi had to pay for all of that. And because of lower greenhouses, like tomato is the actual example here. Their own greenhouses said we can't do hothouse tomatoes because gasoline to heat the hothouses costs too much. And let's go import from country X. And country X said, well, we have drought, so we're going to charge you 3 times the price or 4 times the price. And 17.5% inflation across the entire economy is what they experienced in January 2023. What did the grocery stores do? The grocery store said, you know what, I'm not going to put a lot of tomatoes on the shelf because I don't see the local, resident paying $50 for a box of tomatoes or cucumbers or peppers. The grocery stores went empty. The shelves went empty for fresh produce. Well, what do you think happened to the grocery store profits? They fell. What do you think happened because the grocery store started making less money? The support infrastructure for that started decreasing. The locally produced crops then started failing. Since there are no tomatoes, no cucumbers, no peppers, the other things that go into the salad as well were going waste. And one by one, the ripple effect started becoming bigger and bigger. Growers, farmers said, well, I can't make tomatoes effectively. The weather in our country doesn't enable me to farm tomatoes the entire year. And so 1 out of 10 fresh food producers dropped out of business, went out of business in the last 90 days. Tomatoes used to cost $7 a box. It is now $25 a box. What will you do if a box of tomatoes, 6 tomatoes, are $25? What will you do? The, the actual statement that was given is, hey, who cares whether inflation is 17%, 18%? We've got nothing on the shelf. We just took it off the shelf because there is no point in putting it on the shelf. If you were a resident of St. Neldangi, what would you pay for a tomato? The reason I ask that question is when inflation is very high and substitute products are very low, you, the customer, are willing to pay a premium. And now for the surprise. St. Neldangi is not a fictitious country. I use Scrabble to say England. In England, there is no salad on the shelf. This could happen to us too, except I doubt it is going to happen to tomatoes because we produce a lot of tomatoes. So you have to sit back and think about where are our supply chain problems? Where is inflation likely to come for us? What do we import a lot of? What is the problem of that country? And I say that so you can think through as a value investor which product or commodity stands to gain. Let's talk about, and by the way, here is a Reuters article. You're welcome to read that. It literally says more food shortages could cripple Britain. All right. Another case study. And Pakistan is a country whose economy is ahead of Finland and Portugal. It is by no means a really small country. By no means should we take this as it's never going to happen anywhere else. A real case study. The Fiscal Story, their GDP ratio is 80%. The US is more than that, 120 something, right? And so they have a debt load, but it's not a crippling debt load. Unfortunately, 80% is terrible, but again, there are other countries with more than that. And if you look at their GDP growth, it has grown anywhere from 6, 7%. It's a little bit on a lower trajectory. COVID truly destroyed them. Unfortunately, it went from 8 to 2. They actually had a recession, and they thought, hey, maybe we came out of the recession, and they were, looking forward to what is happening. And if you look at their inflation, the surprising thing is COVID was not what caused their inflation. It actually happened a few years ago. COVID actually caused an inflation for them. How about that? The reason COVID caused an inflation for them is because, again, of their supply chain. The things that they really needed were imported. And when their supply chain shut down, the vital things that their country needed cost many times more. And here is the sad part. Inflation has been stubborn. Here is a term that Chairman Powell has used about the US economy, about the inflation being stubborn. Now, inflation being stubborn for 1 quarter or 1 month at 6% is one thing. Every year, each dot here is a year. Every year for the entire year, their inflation is 10% or more. Here is what that does when you have 10% inflation year after year and a GDP growth of 5%. The negative effect of that is your buying power drops by 5% a year, every year, many years in a row. Watch what happened to their exchange rate. The purchasing power of the Pakistani rupee torpedoed in the last few years by 35%. And when you have that happening in a country that imports stuff, all of a sudden things you import cost more, your own country's inflation is higher, your GDP is not growing, and the net result is the highest ever inflation of 35.37%. And that is a very, very hard reality. And there is a reason why I'm reviewing this case study as well, and that's also in Reuters. Here are the lessons. To sit here and say the Fed should give up on the fight against inflation because, the banks are going to go bankrupt, or we don't want to, affect the structure of the economy, that is A, foolish, and B, dangerous. The Fed absolutely has to destroy inflation, bring it down to a much lower number. Its job is not done until then. Interest rates, in all likelihood, will have to stay high. Even though we may sit here and say long-term interest rates have dropped, the odds of short-term interest rates dropping any time in the next year, for logical reasons outside of any other external things such as COVID or some other war or something like that, the odds of short-term inflation staying at close to 4%, north of 4%, I would say are very, very high. It is not going to fall. More industries may break. Heavily leveraged industries will break first, and therefore, what does it mean for you and I? The price of a stock is the present value of future earnings. And we saw earlier, even with COVID, the market appears to somehow think that we are now, companies' cash flows are now better than they were ever before. You have to ask the question, take any company, take a consumer discretionary company, a company that makes ice cream. You may say, I can buy ice cream if it is 5% more expensive. How about a car? How about things that cost more money now? Are you going to increase your purchases even though things cost more in the current economy? Because the profit from that increase, after paying higher wages, the present value of the future earnings is what is represented in the price of a stock. Long story short, companies that make things that have no substitutes will have pricing power. The rest of them, in all likelihood, are unlikely to post sound earnings. Food that you cannot live without, and we saw salt as an example. You can Google salt. Salt is produced in salt mines. However, the mines that produce salt also produce 100 other things. There isn't a pure play salt player. And you also need to wait for the correct valuation. You can't just jump and buy everything. So what we are going to do is take these three concepts. What are things you cannot live without? Which companies' valuations are representative of the new reality where the future earnings may not be as high as we think it is? And which companies are on a very strong financial footing that they don't have to go borrow at these high interest rates? In the next episode, we're going to look at precisely those indicators. We're going to look at enterprise value, debt to equity, substitute products, and create a thesis and narrow it down. In the meanwhile, the ice cream is melting, but it still tastes good. Short-term treasuries paying 4 something percent. It's 4.7 if you buy 3 month. That's pretty good. And the best step for now is to just sit tight, short-term treasuries, wait for the debt ceiling drama, and hope and pray that somehow we get through it and we don't see a default, and keep learning about value investing. It does not appear to be the time to jump into equities, but it certainly is the time to learn, invest in short-term treasuries, wait, and see where we go. Feel free to email me. Look forward to the next episode.